Our next speaker for today is Robert Promisel. Robert is a portfolio manager at Resolution Capital. They manage the Nedgroup Investments Global Property Fund. Rob, welcome and thanks so much for joining us.
Hello, it's great to see you. Thanks.
Thanks, Rob. I know you're traveling soon, so we really do appreciate that you were able to join us for the session. So, Rob, I guess just to start with performance then, please. I know that listed real estate has had a good quarter. Please talk us through the fund's performance, as well as if you can please highlight some of the key contributors and detractors to your results.
Right. So, listed real estate as a investment class was up just over 4% in the third quarter. The portfolio's performance was benefited by its exposure to healthcare, primarily seniors housing, its exposure to retail, and its underweight exposure to industrial. Regionally, an overweight in Europe and in Australia, where results were very strong, benefited. On the other side, performance is limited by the exposure to offices and exposure within the UK and also to self-storage.
And Rob, how are you currently positioned from a sector perspective?
The largest sector exposure within the portfolio is retail, which covers both necessity retail, grocery-anchored open-air shopping centers in the U.S., and enclosed malls, outside the U.S., which also have a grocery component both in Australia, in the UK, and in continental Europe. The largest sector overweight is healthcare, driven by the visibility for earnings for seniors housing, very strong fundamentals in that sector right now. The sector also has a significant overweight to self-storage, which was a detractor in the most recent quarter. That we do see the tide turning in there, and then there is a significant overweight to data centers, where we think that increased digitization of the economy is really driving demand, supercharged by AI most recently. The portfolio continues to be underweight industrial warehouses, where we see a number of the portfolios as being over-rented on a multi-year basis, and we expect that to limit internal growth going forward, again, over a multi-year basis.
Thanks, Rob. I mean, just to perhaps pause and reflect for a moment, I just want to ask you, because you've obviously got so much experience under your belt, but have there been any notable trends that you've observed over the last couple of years in the universe, please?
Yeah, look, what we've seen in the past, really since pre-COVID, and it's just a trend that's been continuing for over a decade, has been a broadening out of the composition of the listed real estate universe. And you can see this chart showing over the past, really again since pre-COVID. You've seen the decrease in some of the weightings of traditional real estate sectors, like office has really fallen by 50%, from 18% of the benchmark to about 9% of the universe today. And it's been supplanted by growth in some of the non-traditional or more emerging sectors. So data centers has gone from a 2% to an 8% composition. Healthcare, again, really fueled by seniors housing, has increased 50%, from 8% to 12%, and you can see the growth in self-storage has been similar. So we are seeing a shifting, and part of the reason for this has been the sector exposure represents where there's been growth in demand, and growth in really growth in demand, if you will, for different sectors, and that's led to just increased exposure to these new sectors.
Yeah, it definitely seems like quite a big shift over time. And then, Rob, I also just want to ask you, so just at the moment, what valuation opportunities and catalysts are you seeing that makes you excited about this asset class?
Sure. So right now, where we sit, REITs are trading at a discount to net asset value. To put it a different way, we think that the listed market represents value compared to the direct market. So the properties are trading at discounted valuations, in the public markets compared to if they were to be traded privately. So we think that there's a value opportunity for REITs in that regard. At the same time, we see the operations for much of the universe strengthening, and this is really best depicted by a couple of slides here. One, we expect earnings growth for REITs to accelerate over really the next several years, and that's driven, as you can see, by the occupancy, by increased utilization, where occupancy or utilization has trended higher for many of the sectors. One exception looks like it would be office, where you've seen vacancy increase or occupancy has decreased. However, we see the office market as becoming increasingly bifurcated, and in fact, tenant demand is becoming quite strong and deep for the upper end of the office market. Newer properties that are in transportation-rich locations, such as in New York around Grand Central, train station or Penn Station. And so the utilization for the newer properties is actually quite high compared to the overall office market, which is weighed down by increased vacancies in older buildings and more suburban locations. So we're really constructive on where values are for REITs today relative to direct market. The fact that the operating environment is increasingly constructive, where we see improving earnings growth, and frankly, where the portfolios are filling up and utilization is trending higher.
Thanks, Rob. I mean, perhaps now we can take the opportunity to delve a bit deeper into some practical stock examples. So if you can please share what are, let's call it some of your favorite stocks in the portfolio, and how do these actually reflect some of the underlying themes in your strategy?
Sure, Neil. All the stocks are our favorites, right? It's in the portfolio, but I do want to just kind of highlight 3 or 4 names that are particularly interesting here. Unibail-Rodamco Westfield is a 50 billion euro mall portfolio across continental Europe, UK, but really London, and then some key properties in the US. We see this as a portfolio that's poised for continued operational strength. Again, as the properties are, tenant demand is strong for these locations. The balance sheet is, it was stretched as we went through the pandemic, and there's a plan in place which we think is quite workable for leverage to reduce from over 9 times to under 8 times over the next 3 years. And in the interim, the debt has a good term to it and fairly limited interest rate exposure. They've reinstated the dividend, which we think will grow lockstep with earnings. By the way, the stock trades at about a 7% implied cap rate and just about 9 times next year's earnings. So we see this as an attractive, a good portfolio that's attractively valued in the public markets. I also want to profile the largest position in the portfolio, Welltower. Welltower is a $125 billion US company. This is not a small company. It's a very substantial company. It's the largest owner of private pay seniors housing in the US, which is really going to benefit over the next decade plus of the aging demographic trend, where you see the baby boomers just beginning to turn 80, and 80 is important because that's when demand for seniors housing really picks up. At the same time, there's quite a bit, there's very limited supplies, quite a few headwinds against new housing construction from replacement costs are up substantially, and there's limited finance. And so as a result, where you have accelerating demand and limited supply, earnings are quite strong. They're seeing occupancy growth. They're having very strong rent growth, and they're working to control their operating margins, their expenses, if you will. At the same time, this company has one of the strongest balance sheets in the listed space at just about 3 times net debt to EBITDA. And overall, we expect earnings to grow at over 15% on a CAGR basis for the next 5 years. Then if I were to turn to another company, it's a profile, it'd be Digital Realty. It's a $60 billion data center behemoth with exposure across all the major continents, North America, Australia, Asia Pacific, and Europe, UK, really benefiting from increased demand for purpose-built data centers driven by the internet, cloud activity, and now AI. They have a strong development pipeline that has good leasing visibility. They expect to generate well into the double-digit returns. At the same time, the company has a well-positioned balance sheet at just about 5 times net debt to EBITDA, really improved over the past 2.5 years. And so that means that they're going to have less interest rate headwinds going forward, and more of the cash flow is going to fall through to equity shareholders. We expect the earnings to grow about 8% over the next couple of years, up significantly over the past 5 years. And you remember back one of the earlier slides, I talked about how we think earnings is poised to accelerate over the next 3 years. This is a clear example where we can see that happening. And then finally, I want to talk to Big Yellow, and I'm actually so glad to be able to talk to you about it, to do this presentation today rather than a few weeks ago, because Big Yellow is it's really the brand leader for self-storage in the UK. It's a £3 billion portfolio, just over 100 properties. Significant portion of the portfolio, as you can see on the chart on the right, is concentrated around Greater London, where it's extremely difficult to develop. And this is a purpose-built portfolio for the most part that management has developed over the past 25 years. We expect earnings growth well, it's at a low point right now, and we expect it to accelerate really beginning late in 26 and into 27, as you start to see more of this development pipeline they have underway lease up and start to kick in. Leverage is very strong, so the company has positioned its balance sheet with low leverage, about just under 15 times LTV, 3 times net debt to EBITDA, one of the lower leverages in the listed space. We think that the value there's clearly value there, a discount to net asset value. And the reason why I'm happy to talk to you about it today is that the company is, well, there are rumors that are breaking in the market that there might be interest in M&A involving Big Yellow, which we'll see how that eventuates. The stock has been up strongly on the backs of that. It's up about 20% in the trailing 3 months, about 22% on a year-to-date basis. So, it's an example of a brand leader that's extremely well run with a strong balance sheet, and typically good things happen to good real estate over time. With that, I turn it back to you, Anil.
Thanks, Rob. Yeah, definitely some interesting companies with some very good prospects in the portfolio there.
I hope you can appreciate just the diversification of the examples we've talked about. From a global leading regional mall company to largest owner operator of private pay seniors housing, not just in the US, but also in Canada, and significant exposure in the UK, to one of the largest owner developer operators of data centers. And then finally, a gem of a company, a portfolio of self-storage in the UK, really concentrated on Greater London. So just a broad example of how the portfolio is diversified and how your client's capital is invested.
Which I think is a very good reflection of your process, that you're not kind of just narrowly focused. And
Right.
And Rob, so I guess, just the last one from me for today. If you can please, let's say, summarize some of the key points from our discussion, as well as to talk about, let's say, your outlook for the asset class going forward.
Sure. Well, look, I just want to start talking a little bit about the table on the right, which shows the composition of returns for global REITs compared to equities and bonds, really over the past 30 years. you take a long-term perspective, you can see the role that income has played in the overall total return equation at roughly 60% of REITs total returns driven by income. The reason I mention that is we're really constructive on the operational outlook for REITs going forward over the next several years. And as earnings are poised to accelerate, we think that dividend growth should remain strong as a result, just reinforcing what this long-term performance trend has been for REITs. The reason we're constructive on REITs and is that when you bring it back to demand versus supply, we're seeing a huge increase in replacement costs across, frankly, almost every market and every property type, driven by labor, materials, and whatnot. And that's having a cooling effect on competitive supply. So, for instance, in seniors housing in the U.S., over the past 3-4 months, less than 1% of existing stock has been started for new construction. As a result, when you have limited supply, tenants have fewer options. And as the economy continues to evolve and hopefully grow, and we're seeing that in certain markets and sectors, then we're going to see increased tension between increased scarcity value leading to price tension driven by an imbalance between demand and supply. So we're constructive operationally on the outlook for REITs. I think that the balance sheets are in strong shape today. Really, since the financial crisis, most of the companies and many of the markets have recalibrated their capital structures and adopted a lower leverage capital structure, which we think is healthy. There are a few exceptions, and we try not to have exposure to those names because we think that there's just much greater risk. And then finally, there's a lot of noise and cross currents in the world today with international trade and concerns about tariffs. And REITs are primarily domestic businesses. It's not to say that they're completely insulated, although we do have an underway to warehouses and industrial, which would be directly impacted. But a lot of the demand that we're talking about, and you look back, think about the examples that we talked about today, whether it's Unibuy or Welltower or Digital or Big Yellow, demand drivers for these companies are really domestically driven, or they're secular driven, such as the case with digitization of the economy. And then finally, M&A is always a lurking potential, and we'll see how that plays out. But overall, net, we think that REITs trade at an attractive value relative to direct real estate. It's a broad opportunity set, and the operating environment, the outlook is constructive, both on a demand basis and really on a supply basis. So thank you very much for the opportunity to speak with you about this today.
Thanks, Rob. Those are some really good insights. I think it's quite easy for anyone to be excited and optimistic about REITs, just listening to your presentation. But Rob, we really appreciate having you here, and thanks so much for making the time to join us.
Terrific to see you. Have a great day.
You as well. Safe travels. Bye.